After a difficult 2020 for global listed infrastructure, what is the return outlook for the asset class, and why is now the time for investing in global listed infrastructure?
Yes, Duncan, 2020 has seen some pretty significant underperformance of global listed infrastructure. Some of this relative underperformance does reflect the specific impact of COVID-19 on a few of the subsectors, mostly in the airports and to a lesser extent toll roads, but we do find the vast majority of this underperformance to be unwarranted. Over the course of 2020, global listed infrastructure underperformed global equities by more than 15%. And you can see that even in the last 2 months of the year, when we had multiple vaccine announcements and the transportation stocks did begin to recover, global listed infrastructure continued to underperform in each of November and December as well, closing out the year near its relative bottoms versus global equities. As you can see on the chart on the blue line there, the FTSE index, which we think is the better of the infrastructure indices, that ended more than 15% down relative to global equities, and the S&P Global Infrastructure Index almost 20% under global equities over the course of 2020. Additionally, we find the absolute return outlook for the asset class today is really attractive. Our forecast returns for the portfolio haven't really been at this level at any point in time since our inception of the strategy back in 2012. It's at a time or a market environment which we think should be really supportive for global listed infrastructure as an asset class, structurally lower bond yields, increasing economic uncertainty in the market, yet returns are looking really as strong as they have ever been at any point in this cycle in terms of the forward outlook for the asset class. And I think you can really see this in the increasing amount of direct infrastructure investor transactions that are taking place at pretty material premium to comparable listed companies held within our portfolio and our greater focus list. And it's for these reasons why we think today the global listed infrastructure opportunity is really attractive for investors.
Reflecting on the year that's been, COVID-19 has had an impact on infrastructure assets and also probably provided some opportunities. What have you done with the portfolio over the course of 2020?
Yes, Duncan, there's been a couple of material changes in the portfolio over the course of 2020. The most prominent one has been our continued shift towards electric utilities in North America, predominantly in the US, where we are seeing the continued drive of decarbonisation as part of the energy transition mix away from fossil fuels. This is really stimulating significant amount of growth CapEx spend. These businesses have really underperformed through 2020, which fundamentally does not really stack up with the earnings that are coming through. The vast majority of these businesses have seen very little to no impact from COVID. In fact, some of them have seen really amplified CapEx programs coming out of it. The other area of change within the portfolio has been on the transportation side. Somewhat fortuitously, we started 2020 with the lowest exposure to airport assets that we'd had at any point in time since the history or inception of our strategy, and that really reflected the valuation opportunity or lack thereof at the time. Over the course of 2020, as COVID really impacted these assets, we didn't increase our exposure materially, largely because of the structural impact that COVID is having on the outlook for passengers in the near term at least. Our bigger focus has actually been on rotating the portfolio more towards those transportation assets that we do see a much quicker recovery, specifically some of the toll road networks around the world that are seeing return to normal a lot quicker, as well as our continued high conviction position in GetLink, the owner and operator of the Channel Tunnel, which is disproportionately exposed to freight as well as car traffic between the continent and the UK.
You've continued to rotate into regulated utilities, especially in the US. What opportunity do you see here for the portfolio?
Yeah, many of these assets are actually trading at levels we haven't seen in a long time, and we think the underperformance through 2020, as I said before, is largely unwarranted because of the lack of earnings impact from COVID. And in fact, the growth outlook has really been extended by that energy transition over the period. A lot of these businesses have very long-dated CapEx programs, which is driving earnings growth for many years into the future. And today, we think the opportunity is more exciting than ever, not just because these businesses help facilitating the energy transition piece, but because the returns available to them, or the spread over the risk-free rate between the regulated returns that the regulators are giving these businesses and the cost of capital has never been as great as they are today. So couple that high risk premium available to them with the increasing growth outlook, and we think the valuation opportunity today is really attractive for investors in a market scrambling for returns.
How are you seeing the energy transition driving returns and opportunities?
It's a really interesting area that we've been focused on within the investment team, and it's certainly a growing area of interest for investors. We've actually just published a new white paper on the energy transition topic in the US, and that's available to investors today. At a very high level, the paper considers how the energy transition mix is being considered in the US and balancing that need to transition away from fossil fuels to decarbonize with key factors around affordability, energy security and supply. So as I said, that's available on the website. Some of the key takeaways in there also consider the implications for portfolio, and we do discuss how we have been shifting the portfolio away from businesses that we do see as somewhat more structurally challenged by this energy transition. So some of the regulated gas utilities where future growth outlook is somewhat more challenged, towards some of those electric utilities that I talked about earlier. And overall, as we've discussed already, regulated utilities in North America are now the largest portion of the portfolio that they've ever been, really driven by this electrification piece. Over the last 2 years, the portfolio exposure to North American regulated utilities has effectively doubled to about 40%. That's really where we see the opportunities today.
Finally, in terms of outlook, how would you assess the relative opportunities of global listed infrastructure versus global equities?
Yeah, that's right. If you think about 2020, as I said at the start, 15 to 20% underperformance versus global equities. The majority of these businesses didn't have earnings impacted in any way whatsoever by COVID. Take out airports, most of the regulated utilities, the contracted assets, even a lot of the toll roads have already returned to near normal levels of car volumes and truck volumes because people are too afraid to be on public transport. So most of the opportunity set is really in a good place today. From a valuation perspective as well, we haven't seen such a strong potential return outlook as we do today for a very long time, really since the few years beyond the global financial crisis, which is 10, 12 years ago now, in terms of these levels of returns. From a valuation perspective as well, as you can see on this chart here, the relative EV to EBITDA multiple of global equities and global infrastructure, or the other way around. So our focus list relative to global equities hasn't been this low ever since the global financial crisis as well. And I think that again highlights the value opportunity that we're flagging here today for the asset class relative to global equities and potentially other asset classes as well. I think final point, the premium being paid by direct investors, the transactions that we've started to see as the market has become unfrozen post the initial impacts of COVID-19, those transactions continue to occur at pretty material premiums to where comparable listed companies in our portfolio and our broader focus list are trading today. We think a lot of the direct investors are seeing the value on the table today, and I think the listed market continues to underappreciate that, certainly as you can see from that relative underperformance over 2020.